Morning, everyone. This is Barry Knapp from Ironsides Macroeconomics. It's Monday, May 10th. I'm coming to you from cloudy Cambridge, Massachusetts. This is our first trip back east since relocating to Colorado in the midst of the pandemic a year ago. Our note this week was titled Partial Yield Curve Control. It was released on Saturday morning, as usual, on May 8th. There's 4 sections to today's podcast, YouTube video, and our note this week. The first one was about risks to the reflation trade. The second part of the note, which was so prominent, obviously, on your screens last week, the second part of the note was titled Ignore the Supply Side at Your Peril. This was a review of Friday's labor market report that was so shocking, at least on its headline. The third part of the note was partial yield curve control. This is all about the incredible divergence between the break-even component of Treasury yields, particularly in the belly of the curve, which is the 5 to 7 year section that the Fed asset purchases have so much influence over relative to the real rate component. And then the final section of the note was about our downgrade of the healthcare sector this week. So beginning with risks to the reflation trade, the Bank of Canada and Bank of England, which are economies we would consider to be most similar to ours in construct and the nature of those economies, political, economic systems, have decided to taper their asset purchases. There's been an increased amount of discussion in the marketplace about the timing and potential tapering of asset purchases in the U.S. as well. As we noted, 5-year inflation break-evens are at a 16-year high, and the real rate component of that 5-year part of the curve is at the QE era all-time low at negative 1.9%. This has everything to do with the myriad of Fed speakers that came around last week, following on from the last FOMC meeting, trying to assure the market that they're not even talking about tapering, and managed to push this, create this incredible divergence. There was quite a bit of discussion last week, particularly in the financial press, about how can it be that rates are going down and technology and so-called long duration equities are still continuing to underperform. Cloud stocks, for example, got absolutely hammered last week. The software ETF underperformed massively, and the reflation-related sectors, materials, energy, industrials, and financials performed exceptionally strongly. And this is because of that big divergence in rates. We think that the payroll report likely, and by the way, this isn't a new phenomenon. We showed a chart in the note that industrials have been outperforming tech fairly persistently since August. So this reflation dream theme that some may consider transitory or just early stage business cycle action is not that at all, in our opinion. We think it will persist through the cycle. Nonetheless, when we do get to the point where we start talking about tapering asset purchases, that will put this reflation trade at fairly significant risk of a setback nonetheless. This brings us to the second section of our note, which is the reason why a lot of that risk was mitigated even as we were writing the note when payrolls were released on Friday morning. To be sure, there's a very valid argument that faulty seasonal adjustment factors, and we've been writing about this through the pandemic, how pandemic behaviors have changed seasonal adjustment patterns, buying patterns and hiring patterns, and that's thrown off seasonal adjustment factors and distorted the data at times. That was certainly true of jobless claims last summer, and it may very well have been true of the April payroll report. On an unadjusted basis, we've had 2 months in a row of better than 1 million jobs, yet the headline numbers were adjusted significantly lower to the massive miss of 266,000 last month against expectations of 1 million, and the previous month was revised down fairly significantly as well. Nonetheless, It's also very clear when you look at jobless claims, and this is something we've been writing a fair bit about, that initial jobless claims have plunged, meaning layoffs have slowed to an absolute trickle, yet continuing claims have not fallen throughout 2021. They've remained at around 16 million after trending down steadily from August of last year, when the $600 additional unemployment insurance per week from the federal government was ended, through the end of the year when it was reinstated to $300. Those continuing claims have remained high. So for us, there's no real question that one of the contributing factors to the tightness of the labor market, to sluggish hiring growth, not layoff growth, not the separation side of the economy, but the re-engagement of the economy, is being impaired by those extended unemployment benefits. Now, to be sure, recalcitrant teachers unions are a factor. Early retirements look like they were a factor, or are a factor as well, as fears of the virus. Nonetheless, those employment benefits should probably be ended sooner rather than later. Some of you may have seen that Montana and South Carolina decided to withdraw from the program last week. We suspect more states will look to similar approaches to try and re-spark the supply of labor and unclog the labor market. We've been arguing that the labor market's much tighter than most expect, and that there was going to be upward pressure on wages. When Chairman Powell said, gee, we haven't seen any evidence of upward pressure, he was being disingenuous, because typically wages would have fallen sharply through a recession. In this case, they did not. And the average hourly earnings component of Friday's number was quite strong on a month-on-month basis, quarter-on-quarter, seasonally annualized, any of the shorter-term measures. It does look like there's a lot of upward pressure on wages, particularly in the areas you would expect there to be, like construction, for example. So that's it on that. One final note actually is, on the K-shaped recovery arguments, there was actually quite a bit of progress made on minority, female, less skilled worker unemployment rates, all of which fell fairly sharply last month. So that's very good news for the administration and the Fed that are focused on an inclusive recovery in the labor market. There was some improvement, significant improvement in those categories last week. Now, the title of the note this week was Partial Yield Curve Control. And what that's really all about is, if you decompose the yield curve into its various segments, the 2-year or short end of the yield curve, 2 years and in, is heavily influenced by interest rate policy. The Fed is determined not to lift off the zero lower bound for quite some time, and will undoubtedly start tapering asset purchases before they actually start raising rates. That part of the curve the belly of the curve, 5 to 7 year section, is heavily influenced by asset purchases. And then, of course, there's the very back end of the curve we've been writing about, that's been so influenced by 5.3 trillion deficit financed government spending. That's the 2s, 30s real rate curve we've been writing about. Or in this week's note, we showed the 5-year, 30-year real rate curve to try and isolate the difference between that borrowing, expectations of borrowing, and the asset purchase component. Now, we were asked recently, do we see any evidence that Fed asset purchases are actually having any economic impact? And we would say, with respect to the Treasury purchases, probably not. With respect to the mortgage purchases, yeah, they're having an impact, but you could strongly argue strongly that it's actually counterproductive. We have house prices growing at 12% per year. Lumber prices are all over your Twitter feed. If you follow FinDwit, for example, construction employment wages were up, as I noted a little bit earlier. And the Fed is buying more than 100% of net supply of mortgage-backed securities. Boston Fed President Rosengren, not far from where I am today, commented last week that there is an argument to be made that the housing market does not need this level of support. It appears, based on a lot of anecdotes, that first-time buyers are being crowded out by investors Last cycle, the housing market cleared with investors. This cycle, we actually have that organic bottoms-up demand. Household formations, as we've been noting, have increased decidedly. Millennials are moving out of their proverbial parents' basements, forming households, and we do not need to give this level of stimulus to the housing market. So although it's unlikely, we would not be totally shocked by a change in the asset mix from mortgages to more treasuries. So reducing the purchases of mortgages and increasing the purchases of treasuries, even as soon as June, though Rosengren so far has been the only Fed official to be talking about whether the housing market actually does need this degree of stimulus. That would have a profound effect on market volatility. Recall, this is a topic we've written about a fair bit, which is the repression of volatility is primarily a function of the Fed buying 100% of net supply of mortgage-backed securities and not hedging prepayment or convexity risk. So were they to slow their purchases, that we would see a move up in fixed income vol right away. For us, that remains the best portfolio hedge for people, is to buy interest rate vol. It is exceptionally or exceedingly low because of those mortgage-backed securities purchases, and will jump sharply higher if the Fed were to start slowing the asset purchases. This for us is also the most probable cause of a broader risk-off event that would take the equity market down, say 10%, cause a 10% correction. Again, a topic we've been writing about a fair bit. So that's it on that topic. This brings us to the final topic of this week's note, which was a downgrade of the healthcare sector. And it was prompted by the Biden administration decision to not protect the intellectual property of the vaccines, to accede to requests from South Africa and India that we give them the intellectual property. This is just incredible to us, against the rule of law, very negative for innovation. But more than anything, what it says to us is that the Biden administration healthcare policy is being controlled by the progressive left, and that as we move towards the American Family Plan, we're going to see policies that will likely keep this sector under a cloud, much as it was under a cloud back during the early days of passage of the PPACA or Obamacare. And whatever you think about the policy from a longer term, social welfare good perspective, we think it will keep the sector under pressure. And so between now and passage of that, sometimes this fall, we think the healthcare sector will be under a cloud. It never really fit into our reflation theme. Our reason for being overweighted, and we still think this is valid, is that there will be a big increase in technology innovation adoption in the sector. So healthcare technology, healthcare services focused on technology, we think is still a very valid secular theme through the cycle. So we wouldn't completely dispose of any healthcare holdings, particularly as it pertains to that secular trend. Nonetheless, we think the sector is going to underperform for some period of time until we get that jobs plan really starts to take shape. So we're taking healthcare from an overweight all the way to an underweight, and we're going to reduce our healthcare holdings, and we suggest you do the same. So that's it for me this week. We will likely get out a somewhat abbreviated note because of our travel schedule. We're in Boston now. We'll be in New York City for 3 days, and then in New Jersey for 4 days after that. We'll be returning to Colorado next week and get back on our regular schedule. But we will do our best to get out a note this week. The JOLTS report for us is very important to be released tomorrow. It will tell us a lot about this supply of labor questions, how many job openings there are, what kind of turnover we're seeing in the labor market sector by sector. And then, of course, the inflation numbers loom very large this week. Don't look at the year on year. We get the base comparisons. The Fed doesn't need to lecture us about that anymore. We do need, though, to see what the numbers look like on a quarter-on-quarter basis. And as we've been saying, we think the only thing that's transitory about inflation right now is service sector disinflation, not goods inflation. That we think will persist through this business cycle as we move away from stretching our supply chains all over the galaxy to take advantage of cheap labor. The deglobalization or weakening of the globalization trend was in place in the last decade, and we think that will be even more true this decade, and that we are not going to get that disinflationary impulse from goods that we had for the last 30 years. So that's it for me. If you're not a subscriber to our podcast, we'd love you to become one. We'd love you to subscribe to our YouTube channel as well. The video will be produced shortly after this podcast with our help from our friends at Nucleus 195, a great resource for street research. And if you're not a subscriber to our research, of course, we'd love you to become one there. It can be found at ironsidesmacro.substack.com. Barry Knapp, have a good week, everyone. Thank you.